Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. So, good morning, good afternoon, good evening, and welcome to the Live Squawk premium stream. Again, we still haven't updated the title, but we will. Today's discussion is about the September US CPI report. And we want to, as usual, the idea is we want to take you through just the pros and cons, really, of what to look out for, what's expected, what went last, and what do we think investors and traders will be looking out for within today's report. I'll be joined by a guest as usual to help me through today's figure. But before we go into that, anyone who doesn't know who we are and what we do, my name's Harry. This is Live Squawk. We're an audio news service that supplies our trade amongst bankers, brokers, and investors and retail traders. If you go to livesquawk.com, get out a free trial of the service, find out what we do. We're up to the second live audio squawk is what the industry name is. And we bring you and aggregate all the latest news so that you don't have to. And then we'll obviously deliver that live across our platform. We've been doing it for a number of years, and we have a good reputation in business. So please, if you want to trial the service, please do. Go to livesquawk.com and press free trial. Right, I've got that out of the way. The other part of what to say, nothing we say today should be seen as advice or a trading recommendation. We're simply here to lay out the facts about the markets. The content on this show is not appropriate for purposes of making a decision to carry out a transaction or trade. You should always check all the information and prices immediately prior to carrying out any trade, as any competent trader should do. And no content within this program should be seen as providing investment, tax, or legal advice, and no content amounts to any investment advice under financial service laws. We don't recommend any financial instrument, investment, or products, including those discussed on the show. All right, and that's the boring stuff out of the way. Now, I'd like to introduce you to our guest, Jamie Dutter. I've known, again, most of the guests I've known for a long while now, but Jamie Dutter I've known for a very long time. He worked on the live floor together many moons ago. And he's here to help guide us through what's expected. He has close to 3 decades of market experience, from trading on the live market, as I've said, to the fixed income floor at Morgan Stanley. Now a private trader and investor, he writes commentary and also is a consultant to PIQ, assisting the service with growing the information platform. So with that, Jamie, welcome.
Thank you very much, Harry. Great to be here again. And really appreciate coming on.
Awesome. Right, before we get into the reads, what I will do is basically just go across what we're expecting today. So give you the consensus to today's number, and then we can get into the particulars of that of the report itself. So just quickly looking at the consensus then. I'll get that up here. Right. So in terms of today's reading, and also, by the way, on the website, there is a preview of today's CPI report that's named Moderating Core CPI to Ease Concerns of Re-emerging Price Pressures. So economists then forecast a 0.2 decline in September's headline annual CPI rate to 2.3% this month from 2.5%. On the month, the rate is expected to come in at 0.1% versus 0.2% in August. And it should be noted that year-over-year core CPI is estimated to have held steady at 3.2%. Just a quick note, last month's sharp drop in the headline rate provided further evidence that the inflationary pressures have been curbed. The August report said prices fell across a wide range of products, including new and used vehicles, furniture and bedding, and household appliances. However, analysts noted that core service inflation remained elevated by historical standards, even when rental inflation was overlooked. A note here from Citi's Veronica Clark said in August, a surprisingly strong 0.5% increase in owners' equivalent rent was a key driver of the upside surprise. As new rents have already slowed substantially, we continue to think that measured shelter inflation, OER, and primary rents will also continue to slow. But that variation in samples month to month could make this transition period more volatile than usual for this typically very sticky component. And with that, I'll bring in Jamie, and we can discuss, just what to look out for in today's report. So, Jamie, my first question to you is: does CPI, and this is a headline question, does CPI still really matter in today's?
Big question, Harry, isn't it? Big question. We were talking earlier about, I think we said a few weeks ago, I said, does it actually matter anymore? And especially with the pivot that we saw by the Fed, obviously in their dual mandate, going from obviously price stability to full employment, and Powell has said that a few times, as well as other officials. Then, the question is, a good one. I think it's kind of been upstaged slightly by obviously Friday's payrolls figures, sort of slightly upsetting that. But generally, I think it's pretty valid to say that they're fairly convinced that they're very close to the 2% target. And especially if you look at their favoured inflation gauge, obviously core PCE, that number has been close to target, actually below target, for a number of months. I think 3 months annualized, actually, and that number is down below 2%. And the month on month as well is sort of hitting that number that we need, which I think is around 0.17%, over 12 months then to hit, that 2% target. So I'm kind of with you, but then that obviously destroys the point of us talking about it and, it being important, because I would say, if we break down the headline and the core headline, possible downside risk because of energy, and gasoline prices, I think, falling close to 4% in September. But then the flip side to that is obviously the core. That's what we all want to focus on rather than the headline, of course. And possibly there are sticky elements in that. So possibly services, expected to stay warm. Goods probably easing, but then I think you probably got upside risk in October because of, the hurricanes, because of the strikes, potentially sort of temporary disruptions really there. And then on core, like we talked about, you mentioned super core, and then rents really being that problem, which is just slowing, more gradually than anticipated. And that's obviously a big weighting and potentially the issue. I think we had an upside surprise in August, 0.5, I think it was, in rents. And then, that just indicates possibly this sort of longer path for the core to hit 2%. That's in CPI. I think as well, possibly you've got, the latest drop in mortgage rates as well, by all accounts, that could possibly sort of stoke upside, upside housing and rent costs. But then, as I say, that's the big issue is rents. And if they do fall, because they do operate with a time lag, we know that, quite a few months, eight plus months type thing. But from some of the, I think it's, the other surveys that you see in rents, then they are due to come down. But as I say, it's taking longer than anticipated, basically.
Which is the balance. Sorry to interrupt. This is the balancing act I think the Fed has at the moment. It's trying to weigh up all these different factors, and obviously if it looks at the core print, and obviously we know that core PCE deflator is this favoured measure of inflation, really. But they don't. It's not. They don't ignore this really, and it all feeds into the same overall mechanism, I guess, in terms of their decision-making process. So it's not going to be ignored for that reason alone. It complements the core PCE or the deflator measure, as we've noted as well.
Sure.
So it does matter. My question was a little bit kind of leading.
No, of course. And my answer was, caveated with, yeah, of course it matters, because like we've said, and I don't want to interrupt. We just said, Fed's favoured inflation gauge, that classic sort of stereotypical line with core PCE, but everybody still focuses on CPI. So, and for what it's worth, Cleveland's Fed's core CPI nowcast number, which did predict the sort of uptick last time around to 0.3. That's at 0.26%, I think, updated today, I think even. So, just for your guide. But yeah, you're right. Of course, it still matters in amongst everything else, right?
Big time. And obviously, because it precedes the core PCE or that personal spending, personal income data, it has that resonance as well, and hence why we talk about it as much as we do, despite it not necessarily being the favoured measure. When we break down this report, then my other question was, what is the key component? What are we looking for within that? And you've touched upon it as well. Is that super core component of the report, because it aligns itself more with that core PCE number? And I guess it's not immediately apparent when the data is reported. You have to go through the report. So as a note, I guess as a side note, it's probably worth remembering that, and if you're listening to Live School, for that matter, listen out for the super core value when we can work it out and bring it to you, because that is what I think will trigger most of the reaction outside of the headline. When people look at the headline number, I think that people start to look at that. I don't think that's unfair to say, would you?
Yeah, no, absolutely. And even this rounding, that we've got into over the last few months, really, that eventually comes out, doesn't it? And then it's either a good 0.3 or it's a bad 0.3 or it's a good 0.2, right?
Exactly. And just a note, I've got a note here from Citi analysts here. They say, while we expect core CPI to be firm for a second consecutive month, core PCE should be softer at 0.2% on the month over month. And they say this will be a good print, although it would likely be neither weak nor strong enough to affect the size of the next cut. We see continued disinflation over the medium term, but the labour data should matter more for the size of cuts. And again, that also goes back to what we're saying now. Although we discount this inflation data because the labour data has now been shown, or it's just gaining more focus. You can't discount the inflationary picture as well. Just been sent a helpful previous. So last month, just for reference, the last US CPI supercore measure came in at 0.327%, unrounded. Sorry, that was the head. CPI supercore month was 0.327, and the annual reading came in last month at 4.453%. So those are these measures within the figure to watch out for anyone trading over the number itself or looking at the breakdown thereafter. Moving on,
and then it's the Fed, isn't it? Yeah, Fed pricing, I guess. Sorry, Harry. Yeah, what do you?
That was my next thing. If we move on to the Fed pricing and now what's built in, again, I think it's common knowledge now that the market's main opinion or main pricing is for 2 quarter point cuts by year end for this year. And so again, do you see anything in today's number that potentially moves the dial on that?
Not especially, right? I think we've sort of had this big yo-yoing sort of pricing scenario from the bond market basically all through the year, haven't we? From 7 cuts in January down to 2 in sort of July, and then we're I think we went to 5 by December, and now we're 2, which is in line with obviously the latest median dot plot. I think really interesting on those dot plots because if you look at them and the history of them, the nearest one, so the nearest year, if you like, so 2024 this time around, that normally does happen, but then 2025 and beyond, kind of not very helpful, not very accurate, and because of obviously known reasons, I guess. 225 basis point cuts seems about right. And I guess we have got so much room to move, to get back to near neutral, still. So as long as the job market doesn't sort of implode too much, which at the moment, obviously, that was just one report, obviously Fridays, but generally the sort of direction of travel is supposed to be that we're easing, and then unemployment should tick up. It's very atypical, I've got to say, that we went up to 4.3% and now we're back down to 4% in unemployment. Really quite odd, and doesn't really, all that data, the jobs data, doesn't really match. I mean, I guess we've been saying that for a while, or economists have definitely. Doesn't really tally with the other data, right? In the ISM, in the beige book, even the Fed's own beige book, and even sort of household surveys saying about the labour market, job market is sort of deteriorating slightly. So, but that said, go on.
Just to argue that, look, there are some anomalies. We've had a lot of union and strike action to play into account. You've had, I think, weather factors. I think will play into what we've seen. So there are some anomalies, and more cynical people that I talk to suggest that an election on the doorstep may have played a part in the last non-farm before the actual election, national elections themselves. But there are factors maybe feeding into the misalignment of survey data compared to national real prints. But we'll see that play out, I guess, with revisions over the next sort of coming months.
Yeah, and Powell said that, right? He said, sorry. Go on. Yeah, Powell has said that, right? Even before Friday's print, he said he'd be marking down the numbers for revisions mentally. So,
They have it in their head already. Just to give you, and just to stay as we stick around with the Fed, I've got a number of a sheet here with a number of Fed calls from the banks, and if I can put it up, I will. But again, looking through the list, only Citigroup really out of the prominent banks, US banks, are looking for anything more than 50 basis points of cuts for the remainder of this year. They've gone for 75. They've been bolder than most in their rate cut calls. And have cautioned about a quickening labour market deterioration, which as yet, as we know, hasn't yet happened. But again, in terms of this year, they're the only ones looking for 75 basis points now call of cuts. Everyone else has gone for 50 basis points of cuts over the next two meetings. And then for next year, the majority, if I look at that, are looking for another 100 basis points worth of cuts. But at the extremes, you've got lots of Wells Fargo, UBS looking for 150 basis points. And then, as I said, the likes of Barclays looking for just 75 basis points of more cuts to come for 2025. So you mean that, we're in a range, as I said, 75 to 150 for next year, 50 to 75 more basis point cuts this year. I even started seeing people say, well, if we start seeing this inflation start to heat up, we could see a pause potentially at one of the next two meetings. Do you think that's feasible?
No, I don't. Not for the next two meetings, really. Like I said, I think the dot plot is fairly accurate near term, and sort of that tallies with two 25 basis point cuts November, December. The market sort of, I think, correct me if I'm wrong, but obviously went from sort of 25 basis point cuts, and it is now sort of down to about 6, isn't it? So 50 basis points higher over the last 2 weeks or so. But that again is just the market getting way too overexcited by cuts, as we've seen throughout this year, really. And at the start of the year, as I said. So I don't want to say don't fight the Fed, all that business, but at the same point, you kind of that figures for the next couple of meetings. And I just think going forward, interestingly, for the non-farm headline figure, I did read somebody saying, it could be negative next time around because of, like we said, because of, the strikes and the hurricanes and all of those impacts. So then what does the Fed do then? Does it pause because of that? Or does it look through them, which it might do with oil, say, and what it does there, for example, then, and again, that's another question to debate, right? Is the oil price and the impact on potentially inflation going forward. Although I guess historically central banks have looked through it as a spike, and are sort of more concerned about growth than inflation on that. So yeah,
There's a lot of things in the air at the moment. Talking about I think talking about down the line, not only for the labour market, but also, I mean, yes, we've had this spike in oil prices now, and you rightly say, central banks try and look through a month's worth of data and these single data points. But there is that underlying issue, like shipping costs and inflation. I've put up on HSBC PC that says container freight rates are elevated on the back of ongoing shipping disruption, and there is a risk that there are higher costs could pass through to consumer prices if disruption persists. Again, I'm not going to ask you how long before we start to see that come through, it's pass through, but this is it is a risk on that level. I think that the longer this goes on, this Middle East situation is now ramped up. There's even a lot of chatter about Israel potentially targeting Iranian energy production plants when they do if and when they do strike back at Iran. So I mean, the risks are building. This shipping issue with the Houthis and what they're doing in the is it Strait of Hormuz, and everything there as well. All this feeds into I guess insurance bets as well, and with people already thinking the Fed have gone too fast, too soon, it's probably another risk that another factor rather that I think will start to play in more and more to people's thinking. Because, as I said, I think it takes, like you said, it takes a while for these things to feed through and to pass through an economy, and therefore the Fed will want to try and get ahead of that, or maybe not want to get too far ahead in terms of cuts in this instance, and look at that side of the picture as well. I know it's something that, and when you look at other central banks, and we're going to look at the ECB, the Bank of England, we've had, for an example, the chief economist and the governor come out and say, I wouldn't say wildly different things, but sitting on different sides of the fence when it comes to monetary policy. So I see that dichotomy playing out amongst a number of central banks anyway, where I think, those hawks and doves both have real cases for their arguments at the moment, and it's a hard time to be a central banker, I think, at the moment.
Yeah, no, I think we're always keen to criticise them wholeheartedly, central bankers, but I think at the same time, if we're in their position, then it might look different. I think just on your point with sort of geopolitics and that type of thing, then the dollar potentially obviously does hold up, and that underpins support for it, because ultimately, do we get a sort of material de-escalation, in the Middle East? We probably don't, right? So then that means oil stays sort of sticky-ish, and then that sort of helps, this reset that we've seen from the sort of overly dovish Fed to something less dovish. Right. And then obviously the election as well plays into that, and then you probably have defensive positioning going into that, and the outcome, as we know, is sort of 50-50, although Trump is sort of made a comeback, I think, the last time I looked at some of the poly markets, at least, although they are slightly skewed towards him, I think. But
I sort of feel sneaky personally. That's my personal view.
Yeah, I know. We've had this conversation, haven't we? And I was kind of not with you, but I think slightly am now, just because of geopolitics as well. Probably helps him, doesn't it? Or at least, the tensions in the Middle East, and then possibly the hurricanes as well. Do they, you can basically have a misstep in a hurricane, can't you? But does anybody ever thank you when you're trying, you're doing your best? And that is probably an issue. And then Biden, generally, is he still there? Is he not still there? Everybody's saying, oh yes, look, he's still the president, but that doesn't probably help the incumbent, right? So that's we can't tell yet, but I guess if we get a broader, sort of more aggressive trade war, then that obviously weighs down on growth overseas,
We haven't
especially.
even touched on that, have we? Really,
No,
with
no,
China
that's probably another chat. But
we're having loads of sideline chats at the moment.
no, of course, no, there's so much going on, right? And yeah, I mean, for CPI, I guess coming back to that oil, or inflation and oil, then yeah, massively dependent on what Israel does. Looking at if it feeds into the Straits of Hormuz, then there is a huge problem there. Obviously, that has something like a third of all seaborne oil basically moves through there, plus LNG as well, which could impact Europe. Obviously through the winter, because Qatar, I think, has more than 20% of global LNG trade, so that goes through there as well. So you kind of then think, even with there's a lot of talk about OPEC plus and their 2.2 million barrels, which can come back online, but if we lose the 1.7 from Iran, the 1.7 million, then yeah, you can see oil, going up to sort of $90 or so, quite easily.
I'll counter that and just say that we have a demand issue at the moment, and the whole
Yeah.
reason I think we didn't see that initial spark and reaction in the energy
Yeah.
markets, because demand was basically more overbearing than the current geopolitical issue, and
Absolutely.
that
Yeah.
demand it hasn't changed. That dynamic hasn't changed. We might see it. We may have seen a stronger jobs report, but the general and trend across the pond, either side of North America or for UK and Europe, is a weakening trend in global demand. So
Yeah.
in that instance, I think that will win out ultimately. But as I said, in the near term, in the immediate, we're looking at all these flashpoints on that front.
Yeah.
I just want to, before we finish, I just really want to try and get your views on the ECB. We've got the ECB coming up.
Yeah.
Again, another basket case in that sense, because from Lagarde saying at the last meeting that they looked at it meeting by meter, but dismissive is probably the wrong word. Was we weren't looking at October rate cuts. Now seems to be the central view.
Yeah.
A central view. Do you have any views on that yourself?
Yeah, I mean, it is a bit crazy, isn't it? And we've followed the ECB for years and years and years, and you kind of always think there's possibly a policy error coming at some point, whether that's fair or not, we kind of will see. I guess, yeah, totally. They were September, it was going to be quarterly rate cuts, and they were, it was going to be gradual and measured, and then, what have we seen since? Everything that we've seen of sorts in the data, at least, is what they expected, and in the September projections. So, GDP came down to 0.2 in Q3 from 0.3 in Q2. That was, what they expected. Certainly, risks are tilted probably to the downside there. But and then inflation, everybody's pointing to that 1.8, obviously undershooting the target. But again, I think Lagarde said herself, didn't she, that she telegraphed that drop. And 1.88 is actually bang in line with their own projections, ECB's own forecast. So you kind of, I think it's obviously looking beyond that then, and a sort of insurance cut. I know some people have been saying, but have we ever seen? We've never seen the ECB sort of get ahead of the curve, have we?
Never.
And their mandate is not the dual mandate, so it's only inflation. So if it wants to act on growth, it needs to be sure inflation is obviously under control. So again, oil big factor certainly, in inflation for for Europe generally, and just as elsewhere in the UK, for example, services inflation still sort of around 4%. And if we do sort of see oil sticking around here, or higher than we've seen, then you get revisions to the forecast obviously in December, the next quarterly star forecast. So interesting, because I think then if you look at the market, we've got something like 4 back-to-back 25 basis point cuts coming up, so October, December, and then the next 2 meetings after that. So interesting sort of meeting, and whether they just say they're data dependent and they're not pre-committing again. But you kind of think, if they react again, then their sort of reaction function has changed, doesn't it?
Well, I think they,
and that's the thing.
You look at the US, and I think there is more of a case for Europe, I think, to cut than there is for the US at some point. So that's just my personal view. You look at the Bank of England, and that's a different. At one point at the start of this year, you could have said all central banks are looking in the same direction. That's not the case. I mean, G7 central banks at least. That's not the case now. That we are moving at different paces, and I think there's a divergence now that you're seeing start to appear amongst these central banks. Well, at least in theory, if not in practice. And that potentially could be a theme for next year anyway. But I think we've got time. We got the data out in about, if you're listening to this live, the data is out in about 45 minutes from now. So it's 8:30 Eastern time, 1:30 London time. Jamie, I'd like to thank you for taking part in today's program and your wise words. Hopefully people got something from them, because I did. So thank you very much.
Thank you for having me, Harry. Yeah, always fun speaking to you, and lots to talk about and watch. Yes. So
if you want to listen into the number, the CPI for those non-subscribers, go along to livesquawk.com, get a free trial. You've still got time. It takes no more than 2-3 minutes. You can also PIQ. It's a good platform for info on what's happening around the markets as well. But join us for our next show. We will be bringing you a show on the ECB and a preview on the ECB as well. So look out for that when it's programmed. And I'd like to thank everyone for listening. And go to, again, livesquawk.com for a free trial. Have a good day, have a good afternoon, good evening, wherever you are, and good trading. And we'll see you for the next show. Thank you very much. Cheers. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.